Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending. Are we calling it April 7th, even though the market's not trading today? We'll call it April 7th. We do have a Good Friday today. Market is closed, so not much action going on. But we're going to dig into the details, and there's a lot happening this beginning of the quarter, right? We're the first week of the quarter, and I think it was telling, and we're gonna dig into that here. Now, I'm Justin Klein. I am host of InvestTalk and CEO of KP Financial, and this week I'm going to title the video "The Coming Recession." Is the coming recession bullish? You know, people often talk a lot about a recession, and they think the recession is like '08, and that's not necessarily. That's usually not the case, right? It's usually somewhere between '08 and like the '01-02 recession, and that was a very mild recession. Obviously, the COVID recession was very fluky and very, had its own dynamics that probably won't be repeated again. So you don't want to dig too much into that one, but it's important to have some perspective and understand that not all recessions are '08. '08 was a financial crisis. Okay. Now let's dig into the economic data. There was a lot of economic data this week, even though there were only 4 trading days. Today we had the jobs number this morning, even though no market movement, kind of odd, but still over the week you had a lot of data. We'll dig into it. First is the ISM Manufacturing Employment Index. That shrank to 46.9. Remember, anything on the ISM surveys below 50 is shrinkage. So that's called 2 quarters or 2 months in a row where manufacturers are cutting jobs pretty much. New orders, that one is at 44.3. It hasn't been positive since August of last year. So you're talking about 1, 2, 3, 4, 5, 6, 7 months of negative growth in new orders. So that's certainly impacting employment and prices here. Prices are now down to 49.5, so they've been shrinking. They were up a little bit last month, but 2, 3, 4, it's basically been negative for 1, 2, 3, 4, 5 out of 6 months that prices on the manufacturing side have been falling. Now that's a small part of the economy. Roughly a quarter of it. And so, you don't want to get too caught up into that side. But most importantly was the ISM services we'll get to in a minute. But the durable goods orders, that came in better than the previous month of February, but came in at negative 0.1. All right. And the ISM services, that one came down to 51.2. So still positive overall, but pretty much at a neutral state. So if you combine the manufacturing, which is clearly shrinking, and the services side, which is modestly positive, you get an economy that is pretty much at stall speed, maybe slightly shrinking. Okay, the ISM prices paid index, that's 59.5. That's the lowest level. Really, we've done a round trip, right? This is September of 2020. It was at 59. That was the last time we were even close to these levels. So the prices paid index on the services side, it continues to go down. So from the inflation picture, that is highly correlated with inflation, and why the inflation number, which comes out next week, is likely to come in weaker than expected. New order index, that was at 52.2. Once again, a little bit above the 50 line. The average hourly earnings year over year down to 4.25. If you zoom out to a 3-year chart, you'll see that this is the lowest level. Let's see, 4.25. Since July of 2021. So clearly in a downtrend, and that's something that the Fed has kind of wanted to break the backs of inflation on the labor front. Non-farm payrolls came in today, 236,000 jobs, really in line with consensus, but average hourly earnings continue to fall. And like I said, with right here, and this was really a dovish jobs number, right? Number was in line, but all the inflation data behind it was decelerating. Okay, so it's pretty interesting to see where the market has moved. Now the market did move today. This is interesting, where there is now a decent chance of a rate hike in May. I still don't believe that. I think the Fed's going to pause, but that was an interesting move on the markets today, even though the markets were closed. Kind of the futures markets and things like that. Those things kind of trade after hours. Anyway, so let's pivot over to the charts here, and the first thing I want to focus on, and I continue to focus on, is the MOVE index, and this is the volatility of the bond market. And if this gets above 150, that becomes a problem, and we're at 147, kind of hanging around there. And honestly, it's a little bit uncomfortable to be hanging around there. If this is kind of a bullish flag here, and I think you can potentially see this moving higher. Now, how much is this because of the banking crisis? How much of it is it because of our fiscal situation, the debt ceiling, excuse me? And so I don't like that it's hanging around there. So that's the number one thing I would say that's the most bearish, is the fact that the bond market is still not acting great. All right, so I want to highlight that. But the S&P strong, kind of consolidation this week, not a shock, kind of consolidating into this jobs number today. We'll see what the reaction is on Monday, but certainly you're bullish, right? You're above all the major moving averages. You're making a series of higher highs and higher lows, so you can't really get too bearish on this market in the near term. NYSE, same thing. You had that pullback. Remember, NYSE has a lot more small caps, a lot more of those regional banks, so that's why it had a larger pullback along with the Russell 2000, but it is nicely bullishly consolidating here over the past week. So we'll see if that can get above the other moving averages next week. I also want to touch on the VIX. The VIX continues to come down. Continues to come down 18.4. As long as it stays below 20, that has to be bullish for the market. And I want to talk about the VVIX to the VIX. So this is the VVIX, and what's interesting here is that this continues to be in an uptrend. So this is a ratio of the volatility of volatility. I know it sounds crazy, but basically, when the volatility starts to move a lot, that is a bearish sign. Okay, and so then when that happens, that this declines, and this makes a series of lower highs and lower lows. And now you're starting to see the volatility fall, and that's what happens when this rises. So this is bullish. You can see this bottomed in October, and it continues to make a series of higher highs and higher lows. That is an uptrend. That is certainly bullish. Okay, and all the inflation data, the economic data, is pointing to we might be really close to a recession. And remember, a lot of people think that's negative. In some ways, it's very positive. And the reason is because that is an impetus for the Fed to pivot, to loosen monetary conditions, to bring liquidity back in the market. And they've been doing that really since October. And that's why I think you continue to see this VVIX to VIX continue to rise. And that is overall bullish. And this latest set of data that I just went over economically with Silicon Valley Bank and all the regional banking crises, that's more impetus for the Fed to put liquidity back in the system. You've seen that with their balance sheet growing to try to help these banks. Now the dollar continues to be in a downtrend, kind of consolidated this week. Really no big move there. But gold continued to be strong, broke above the 2,000 mark on the gold spot price. And if you look at some of the important ratios like silver to gold, bullish. Right, this is above all the major moving averages now. You want to see silver outperforming gold if you're a precious metal bull in general. You also want to look at, let's see what else I was going to look at. Oh, GDX to the GLD. So GDX is starting to outperform gold as well to the upside. That's definitely a positive. Now, where is the biggest negative? And that's going to be in the commercial mortgage-backed security market. These regional banks are big lenders to this space, and the fact that they may be pulling back and trying to reduce their assets overall means they're probably going to be less likely to lend in that space. And that means more defaults of existing loans not being able to roll over. And this rollover of CMBS to the treasuries is a good indicator of that. So that's probably the most bearish part of what I'm seeing. Really, it's about the bond market, that kind of dysfunction. And you want to pay attention to that because the bond market is the smart money. But there can be often on the equity side, bucking the trend of what's happening in the bond market. But you want to be aware of that and make sure that you're not getting over your skis in risk, even though near term the market looks relatively bullish. Now, energy pulled back yesterday, but it was a big move up on Tuesday on the back of the OPEC production cuts, which they were already underproducing their quota, but now you're getting a situation where they are going to be producing less than their true capacity. So they're going to have a little bit more spare capacity here, and it's certainly, from a geopolitical standpoint, not that great, especially for the Obama administration, who's, they sold their, and I think it has a lot to do with the fact that they, above 100, they were selling our strategic oil reserve, and we were going to buy it back at a certain price. I think it was like 65 or something like that. And they never really did that. And so they kind of went back on their word, and Saudi Arabia basically said, well, we'll just do it for you. We're going to do some production cuts and get prices up. So I do think overall that is bullish for energy in the back half of the year. The material sector, that one underperformed just a bit, but looking fairly solid, reasserting itself to the upside. The industrial space, there we go. The industrial space, you had a bit of a pullback there. That one is a bit worrisome as well, the fact that this isn't getting into a strong uptrend. So I'm on the watch for that to see if we get a breakdown below that 200-day moving average. And then I want to talk about ARC. And what's interesting here is the growth side of the market here. I'll show that real quick. IWF. There you go. So this is growth to value ratio. You had some weakness here in growth versus value on the past couple weeks. But what you can see here is here's ARC to the Qs. Oops. There we go. And this continues in its downtrend. It means it continues to underperform the Qs. And it's just another indicator that these kind of Ponzi stocks, companies that are all about the story, all about innovation and being the next great at whatever, and they're losing money to do so, they're going to continue to struggle. They're going to have trouble raising capital. Many of them are going to go bankrupt, and the price of their equities are continue to fall. And so it's interesting to me that ARC can't really get much traction despite the Qs in the first quarter doing pretty well. So I just wanted to highlight that. But overall, the coming recession, which I do think we're going to have a recession this year, is the second and third quarter, is it third and fourth quarter? I'm not sure. My gut reaction is late second into the third quarter. That's when you're really going to see the economic contraction. But will the Fed start to pivot in regards to that, seeing the economic data come in and start to cut rates? And the market's kind of pricing that in, that they're going to do that in the back half of the year. And obviously the market front runs that. The market front runs that Fed pivot. Remember, the market's always looking forward. They're not looking at the headline today. That's why you kind of have to really understand where the market is going, right? Skate where the puck is headed, as Gretzky would say, as opposed to where it is. And so that's what we try to do here and try to help you with on InvestTalk and obviously our clients at KPP Financial. So I appreciate you all tuning in, subscribing to this channel, as well as our podcast InvestTalk, and I hope you have a wonderful weekend. A reminder that the contents of the video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a good weekend.